The stock market just presented all of us with a fantastic learning opportunity. And if you learn this and you actually put it to work in your investing, not only will you most likely make more money, not only will you most likely do better, but more importantly, you will be much less stressed. And this learning opportunity took place right here on the chart. Billions, if not hundreds of billions of dollars of wealth was transferred from the hands of those who either do not know what they're doing, who either are new or perhaps did not learn the basics of the stock market, into the hands of experts, or simply into the hands of people with patience. Now, what's very interesting is not even 2 weeks ago, literally not even 2 weeks ago, there were articles like this and like this, and there were videos like this and like this, screaming that the world was going to end, screaming that stocks were bound to crash. And now, not even 2 weeks later, yes, there was a small correction, but not even 2 weeks later, the stock market is within spitting distance of all-time highs. So, why did this happen? Why did this wealth transfer happen? And why do these events constantly, continually happen throughout the history of the stock market? And why do we as humans not learn that stocks are basically guaranteed to go higher? Well, first let's explain what happened. Let's explain what caused these videos and these articles. These videos and these articles were caused because of this correction. And more importantly, this correction was caused simply because of an unemployment report. The most recent unemployment report was estimated to remain the same at 4.1% unemployment. That did not take place. It actually ticked up to 4.3%, which made the markets, which remember, markets at the end of the day are just people, just like you and me, and institutional investors. It made the markets freak out because it's looking like the economy is not as strong as it once was thought. So, most likely, retail investors, people like you and me, panic sold because of that report, plus all the sensationalized bullshit on the internet. And guess where that money went to? It went to people who are passively investing, who do not care about the ups and downs, and it went to institutional investors and professional traders. Because remember, in the stock market, someone's loss is most likely someone else's gain. So if you want to take advantage of these moments, or at least not give your money to the elites who are on Wall Street, pay attention to this video. Because in this video, you're going to learn why basically it is guaranteed that the stock market will continue to go up no matter what. And that is because it is by design. There is too much money. There are too many retirement accounts riding on the stock market for that not to happen. You see, we live in a capitalist society, and in this capitalist society, there is one thing that must happen, and that is growth. The economy must continue to grow, because if the economy does not continue to grow, those retirement accounts that are based on the stock market, they collapse. People's ability to be able to fund their life in retirement when they cannot work anymore collapses. And wealth of the elites, not the millionaires, but the billionaires, the wealth of the elites are destroyed because they rely on those assets to borrow money in the form of debt to fuel their lifestyles. And if these assets do not increase, that whole game of charades does not exist. So, because this is basically required, what ends up happening? Well, what ends up happening is asset inflation. Prices slowly tick up year after year. You hear it all the time that the Federal Reserve wants a 2% target rate of inflation. Why not zero? Why not make everyone's life better? Well, yes, there are some implications when it comes to monetary policy, when it comes to that, and I've made videos on that in the past, but there is also one major thing. Without slight inflation, you cannot guarantee that companies will profit more every year when compared to the previous year. So that 2% inflation rate is that guaranteed buffer that every year the stock market, all else being equal, will go up at least 2%. Now, when you look at the averages, it is much higher than that. Is usually about 10% that the stock market goes up every year on average. Now, here's the other thing that we have to talk about, and that is the fact that we are in a massive debt crisis. The United States has a massive amount of debt. And even if you trust the politicians to somehow balance the budget and actually be able to have a surplus, even in that scenario, the amount of surplus that we would be able to squeeze out of the budget is minuscule. And it would take decades upon decades upon decades to even make a dent in this debt. So the government has one other option, and that is to inflate away the national debt. Now, this doesn't mean that the national debt will go away, but what it means is that every year that debt will become cheaper to service. Just like if you got a mortgage in the year 2000 and now you're maybe paying $1,000 on a 4,000 square foot house and everybody else is paying 5 or 6. Your debt got cheaper because of inflation and because of asset valuation increases. So because of that mechanism that is by design in our capitalist economy, the stock market will go up every single year on average. Not every single year real, but every single year on average. There will be ups and downs. So when it comes to these corrections, I guarantee that there are some people who sold and now they are behind the 8 ball. And the reason for that is because nobody, unless, especially the people who are selling in these scenarios, these people do not sell at the perfect time. And if you're one of those people, that's okay. Just learn today so you don't do it again. What ends up happening is the chart looks like this, and all these news and all these sensationalized articles come out, and you and other people end up selling here, okay? And then it bottoms out, and then everybody frantically starts to buy again, and you end up buying here. So now you sold lower, and you bought higher, and you probably would have been better if you had just done nothing. So if you want to avoid this, you have to understand two things. One, if you need the money tomorrow or in a month from now, that money shouldn't be sitting in the stock market because the stock market is a volatile market. Okay? If you need the money soon, it should be sitting in something like a savings account. Even 10 years ago, I would have told you the same thing. But today, these savings accounts are giving you 4 or 5% annual return. So if you need the money soon, you should put it in a savings account. And if you don't, if you are investing for retirement, or you are investing for at least 5 or 10 years into the future, when these corrections happen, don't do anything. Do not sell your stock, because even if the market crashes 10 or 20 or 30% or 40% or 50% like it did in 2008, how long did it take 2008 to recover and to then print all-time highs again? A little over 2 years. A little over 2 years, which means that if you have a 5-year or a 10-year time horizon, even if you bought in basically the worst possible imaginable time in history, in our recent history, which is right before the 2008 crash, even if you had invested your entire life savings right before the 2008 crash, within 2 to 3 years, you would have been at all-time highs again, and your money would have been recovered. And within 4 to 5 to 6 years, you would have had significantly more, even if you had invested in the worst time in recent history. So what this means is that if you have a long time horizon, 5 to 10 years, really it should be 10 years plus, but I'll even go as far as saying 5 years even will save you in most scenarios. But 10 years plus, if you have a long time horizon and these fucking events happen and these little corrections happen, do not sell your stock. Stop selling your ETFs. Stop selling your stocks, because once you invested in them, it means that you have confidence in them. And if you've done the research, either A, by just simply investing in ETFs, or if you're going to pick stocks, if you've actually done the fundamental analysis required, then don't do anything. The only thing maybe that is acceptable is dollar cost averaging. And this is something that has become very common nowadays, and that is basically setting a set amount, whether that be weekly, whether that be monthly, whether that be quarterly, setting a set amount and just investing it in those ETFs. Most likely an ETF that tracks the S&P 500, like the VOO or the SPY, or something that tracks a sector like VGT or NOBL. And you just set it and you forget it. Because if you do dollar cost average on the way down, you're going to get slightly more percentage return on the way up than someone who did nothing. So I hope this video was helpful. I just had to talk about it because this just happened, and it is a beautiful learning lesson. Not only the fact that it just happened, but it happened so quickly. I mean, if you type in stock market on YouTube right now, you're going to get videos from 2 weeks ago screaming that the world is going to end and that the stock market is going to collapse. And literally just a couple of, not even 2 weeks, literally 10 or 12 days later, we are almost at all-time highs again. So understand that this mechanism of stock market growth is by design. It is built in. And if you just realize that, you'll either make more money or at least you'll be a lot less stressed when these things happen, or you'll dollar cost average. I hope this video was informative. If you like personal finance, world economics, broken down simply, you are in the right place because that's all we do. As always, my name is Derek and I got my degree in finance, so you don't have to. I've been investing for over 10 years. I love this stuff. I love finance. I actually got into investing before I even got my degree. I loved investing so much that then I pursued my degree. I love this stuff, and I love being able to share it with you guys. So if you like this stuff, if you like the way I talk, and if you like the way I teach, there's tons of awesome content on the way. So please subscribe if you haven't already. And other than that, I will see you in the next weekly video. Until then, stop fucking freaking out. Don't sell your stock. Everything's most likely going to be fine. And if it's not, then we have much bigger problems on our hands. I'll see you in the next video.